welcome back to the channel. Just a very quick one right here. In this video, I will be going through every single ICT institutional reference points and I will be explaining it in detail. So if you don't know what exactly are these institutional reference points, they are basically some of these ICT concepts that you often hear among ICT concept traders. All right, these are the breaker block, mitigation block, liquidity void. All these concepts are important because this is the very foundation of everything about ICT concept. So let's get started straight away. We're going to start with a breaker block. A breaker block is simply something like this. I'm not going to waste your time. I'm just going to show you everything in simple explanation right here. So when you have price moving like this, all right, when you have price moving either in the downside or in an upside, and then you see price suddenly do something like this. All right, when you see price move and have something like a break of structure in the downside right here, and then crashing above it, changing direction. So right here, this is supposed to be a bearish order block, right? This guy is supposed to be a bearish order block because if you're trading this, you're coming down like this to this area. If price comes back to this area, you want to sell. But if this particular order block fails to reject price, then you see price crashing above it, this guy is no longer called an order block, it is called a breaker block. So just like we have bearish order block and bullish order block, we also have bearish breaker block and a bullish breaker block. And it is simply a name derived from the direction that price moves after it touches that particular institutional reference point. So if this particular breaker block decides to push price up, we will call it a bullish breaker block. So just like you can see right here, so as price was coming, hit this place, breaking structure and then changing market structure in this area. Now this guy looks like a particular movement up until we saw this crashing up above. This guy is a break of structure. So now we can say this is a sweep of liquidity and then this is a shift in market structure at that point. Let me change it so you can see it correctly. So this is basically what a breaker block is. And to find it on your chart, I have it right here. Can you see price coming, having this movement, pushing up, coming down, then crashing above? All right. So it is basically a failed order block. This is it. And price moving. So as we are looking at this, as price is printing to the upside, what exactly is your breaker block? You're going to look out for the last bullish order block as price is pushing up. So that is your breaker block. I hope you're seeing this. This is your breaker block. So if price is coming back, we want to see price react from there and then it starts moving. So that's basically what a breaker block is. So likewise, if you want to see a bearish breaker block, it does the opposite of what we've seen here. Price coming up to this area. Let me show you that in a very brief example. When you have something like this crashing and then price relocating to this area where the bearish breaker block is. All right. So it is as simple as that. Don't get it confused. I'm just trying to capture everything for you right here. So until we see this crashing up above this last lower high, we did not have a shift in market structure, which later gives us a breaker block location as price is coming down. And then this one becomes our sweep of liquidity right there. All right. I hope this is explanatory enough for you to understand. So we have finished explaining a breaker block, right? You can check it and check your chart so you can understand it properly. And then the second one is a mitigation block. Now there is a very slight difference between a mitigation block and a breaker block. The simple difference is that when we are dealing with a breaker block like this, we want to see price pushing above the left hand side of this particular M formation. You can actually see. So this is what a breaker block is. When we see price pushing above this guy sweeping liquidity, and then you can see this creating above here. But a mitigation block is a failure swing when you have price pushing up like this and then it failed to even move above this guy, and then it crashes from here. So that's simply what a mitigation block is. When you see price push up, the left hand side is always above the next swing while a breaker block pushes above it. I hope this is explanatory enough. So all of them are failed order block. They have bearish mitigation block and a bullish mitigation block the same way, but the slight difference is simply because this guy has a failure swing right here and then it crashes down, shifting structure. As it is coming up, we expect price to move away from there. I hope this is explanatory enough. Let me find an example for you. Now this movement above, it can either be with the wick. The wick is also considered. All right, so what I'm saying is this: If this is only the wick that just pushed below here, not the bodies, we still consider it as a breaker block. Forget about the body alone. We want to see just a movement above or below the lowest level. Let me find a mitigation block for you, and then I will show you an example of how to spot it. All right, so look at this. I can see one right here. As price was coming up, we have this movement above the left hand side. Look at this guy creating this high, and then the right hand side had a failure swing and it crashes down. So what are we going to look out for? This is a bearish mitigation block, the last sell candle. You can either consider this guy, or since this guy has covered everything there, we can consider it as our mitigation block. I'm going to show you another example. So look at what price did. As price came, touched this area, it started crashing down from there. Let me see if I can see another example, and then I'll show you. So take a look at this. I've seen this one just now. Price came, look at this, and this is a bullish mitigation block. You can see the left hand side is always lower or higher than the right hand side. And then you're going to look out for the last bullish candle as it is moving up before the sell started. That is your bullish mitigation block. So if you bring this to this area, you can see how price is reacting around it. So that's basically what a mitigation block is. I think I have seen another one that I wanted to show you, but it seems like I've lost it. All right, you can see this so many times, time and again on your chart. All right, you can see it time and again on your chart. So let me go back and continue with the rest of the institutional reference point, and I'll show you one after another. So back to the next one is liquidity void. Liquidity void in simple term is when you see a sudden displacement of price from a particular level with a very noticeable candlesticks, and there is not too much of distraction in the opposite direction. Look at this. Can you see this very big candles that we're printing? It's basically when price quickly moves away from a particular level. You see 1 2 3. This is a liquidity void. So basically when a liquidity void prints, we expect price to fill it up in the opposite direction. If these candles were in the opposite direction, we expect it to be filled up. So this is a liquidity void. It is void of liquidity on the other side. There is no sell side liquidity, and that is why you see it quickly moving away from that level. You can see them time and again. All these ones are liquidity void, and you will always see it being filled up in the future. Can you see price filling it up, this movement, and price filling it up to match up all the imbalances that were left out in this area? So that's basically what a liquidity void is. And a fair value gap is the next thing we'll talk about. A fair value gap is simply an anomaly in price action. This is what I mean when I say an anomaly. Normally when price is delivering liquidity, like you can see in these candles. So to be able to identify a fair value gap, you need at least 3 candles, and then in those 3 candles you mention 1 2 3, right? The most important ones you want to look out for is the first and the third candle, either in the sell direction or in the buy direction. The first and the third candlestick. All right, so look at this. If you see a price action where the high of this particular candle is on this wick, let me show you that. Can you see the high of this candle connected with the low of this candle, the first and the third? So this is a balanced price action. There is no fair value gap in this. But if you see a gap left in between them, let me pick 1 2 3 for example. All right, you can see this guy. There is a gap in between the high of the first candle and the low of the third candle. So this is called a fair value gap. All right, so oftentimes price retraces and fill it up because price always wants to balance the liquidity in such kind of movement. That's how the algorithm is designed, balancing these imbalances and then giving it more shape. So this, there is no imbalance here, but this, there is imbalance. So basically a fair value gap is this imbalance in price action. We want to see the high of the first candle and the low of the third candle connected, but in this case it is left open, just like you can see right here. Let me show you on this area. Can you see this one? If I pick here, from here to here, all right, and then this, the high of this first candle and the low of this third candle, 1 2 3, all right. 3 candlesticks. So the high of this first candle and the low of this candle is not connected, and price actually came back to fill it up before pushing up. So that is what a fair value gap. And you have to understand that the colors of the candle does not necessarily matter. So look at this. If you were counting from the downside, we also have a fair value gap right here. We have 1, 2, 3. There is a gap in between the low of this candle and the high of this candle. 1, 2, 3. So price actually came back to fill it up. So that's basically what a fair value gap is. I hope this is explanatory enough. And the next one is an order block. Order block has been confused by a lot of traders out there, especially ICT traders. Let me show you what an order block is. The word order block is a compound word. There is order and there is block in it. All right. So it is basically where institutions are taking huge or large orders. You're going to see it by the kind of price action around that area. So mostly when you see an order block, it either reverses price or it continues with a heavy displacement around it. And this is what I mean. Can you see price coming like this, having this movement, and this last sell candle? Can you see this last sell candle right here? As price was coming down, can you see this last sell candle? This is what an order block is. From this place, you can actually see price moving away quickly to another direction. So that is what an order block is. So there is a bearish order block and a bullish order block. A bullish order block simply pushes price up, and a bearish order block simply pushes price downward. So the last sell candle in this movement is your order block. This guy is your order block. So as price was coming down, it created another order block here. So you can actually see that this order block quickly created this movement, shifting structure, price coming back, and it hit just this order block. It continue moving. So this place is where the institutions have placed their huge order, and basically you will see price quickly moving away from it, as you can see in that example. So do we consider this guy as an order block? This guy? Yes, we consider this guy as an order block, because as price push up, the last buy candle before price crashing down is your order block. Look at it. As price came back to touch it, price quickly reacted from there. So if you want to get the best order block, look for an order block that has a fair value gap close to it. It's one of the order block that gives you the high probability trade. So this order block has a fair value gap close to it, confluence, and then price move away from there. All right. So the next one is a rejection block. Rejection block is a 3 candle price action also, where the high of the third or the middle candle is above the other ones. Let me see if I can see a rejection block. All right. Can you see this candlestick? Where you see these wicks printing? Can you see 1, 2, 3 candle price action there? So this guy is your rejection block. As price came back to him, price quickly got rejected, this guy. So this is a bullish rejection block. All of them have bearish and bullish, depending on the direction they push price. So this is a bullish rejection block. And let me see if I can see a bearish rejection block. You will confuse a rejection block and an order block if you're not careful. All right. So when you have a low or a high being formed where the wicks are being printed, you look for the candlestick with the highest wick is your rejection block. All right. So let's see if I can see another rejection block in this price action. I hope there is one, but I think from that explanation you got what exactly is a rejection block. Let me see if I can see one, just a quick one, so we can go ahead with our explanation. So I saw something here. Can you see these candlesticks? We have at least 3 candles here printing their wicks up. So this guy is your bearish rejection block. So normally price will push above the bodies of the candle and then locate the wick. That is where the liquidity is, and then it crashes from there. So that's basically what a rejection block is. Let me quickly go back and then we continue with the rest. So the next one is what ICT call old highs and old lows. This is basically something simple. It's when you have price just leaving a low. This is an old low. So normally below old highs and old lows, there is what ICT call buy stop liquidity and sell stop liquidity below old lows. So if you see price printing this and then moving away, this is an old low. So if you see price leaving this kind of high and then moving away from it, it becomes an old high. So price may eventually push above it to grab liquidity. So above it, is where all the liquidity are. All right, if I place this, you can actually see that price later even move above it to just grab liquidity right here. So this is an old high. Buy stops are right here. So price push above it and started going to the next direction. So where you see a low created, just like this one at this point, price may eventually come back and fetch the liquidity below this guy. All right, sell stops are here below old lows. So this is a very quick recap on all the 7 institutional reference points that I wanted to show you guys. So if you have any question, let me know in the comments, and then I will go further and explain it for you. Thank you guys for watching. See you in another video.